Joining us now for reaction to the data, Fed's latest interest rate cut, former Atlanta Fed President Dennis Lockhart, and our own Steve Liesman rejoins us. It's great to see you. Dennis, just overall comments for yesterday. You agree with the latest move and agree with the notion that there will now be a pause?
I certainly agree that there's now going to be a pause. I think this is a phase change. The phase that preceded yesterday's meeting and included yesterday's meeting, of course, was an insurance risk management phase. And I now see the committee and Chairman Powell moving into a pause phase in which they're going to wait and see how things develop. But I think there's a high bar for a move in the next several meetings in either direction.
So you think that the benefits we derive from the latest quarter point outweighs whether there's some malinvestment we just are unaware of or some bubbles in places where we're not focusing right now? I mean, inflation is so low, and, 1.9%, whether it's the trade war, whatever, or the slowing economy around the world, seems like you might as well, if there's no inflation, you might as well accommodate the global economy a little bit more.
Well, you can always argue about a quarter point here or there. I think the question you raised at the beginning of your comment was whether there might be some, let's say, financial market instability bubbles or imbalances that are developing. I thought the summary that Jay Powell made yesterday in his press conference of how they very methodically look at all the different elements of financial security was pretty persuasive, and I'm prepared to go with what I know is a very methodical approach to looking at that. So I'm not too concerned that we have fed that beast more by just dropping one more quarter of a point.
Right. Steve, I mean, Bernanke was great. I know that, but as good as he was, what was that famous quote? I really don't see a big bubble in housing in 2007.
Yeah, well,
right.
You always have to be humble about these things because stuff comes out of nowhere sometimes that surprises you and starts a contagion of some kind that no one could possibly predict. But, playing the odds, so to speak, I think the committee's pretty comfortable with the financial stability or instability question at the moment.
Steve, go ahead.
I thought, Joe, that Powell engineered that change yesterday pretty well. I think the market was priced for it, and that's different from the prior times he's sort of spoken his mind about wanting to be limited and measured in rate cuts and even change in policy. The market was priced differently. He went into that meeting yesterday like going into, I don't know, a room of friendly people rather than a hostile room, Joe, which maybe you know something about. I don't know. And people were ready for that change yesterday. And he did it in a sort of two-handed, interesting way. He said, you know what? We're not going to be cutting right away anymore unless the data come in differently. But also that other side of the thing, he really raised the bar for hiking rates, saying we need a significant rise, in inflation above our symmetrical, he must have said that word 100 times, 2% target. So really, Joe, it's interesting to think about. There's a one-way bet in the market right now, and that's either they stay the same or they go down. You don't go in to the market, to your investment committee meeting now and say, look, we got to prepare and hedge against higher interest rates. You'd be laughed out of the room, I think, if you made that call, Joe.
Steve, you told me a pause was coming. I mean,
I did.
The markets were softened up.
They were softened, like artillery.
Right.
Ahead of time.
And as a result, there were no major surprises, I don't think, at all yesterday. Were there? Although you think it was skillfully done, Dennis, the pause?
Yeah, I mean, if there were any surprises, it was the shift from a rate-raising concept of normalization to one that's just really based on inflation. And I thought he was extremely clear about that. And in today's world, it is a little hard to imagine inflation just running wild, getting out of hand. So as Steve said a second ago, and he also said it yesterday afternoon, it looks a bit like a one-way bet.
Yeah. Well, I mean, even if I say, okay, if I could say there's no malinvestment, no bubbles, and no inflation, then why not keep the pedal to the metal and try and grow the economy as quickly as you possibly can with as much accommodation as possible? But then I come to the realization that savers have nowhere to go. Pension plans can't earn a return. People can't retire because they used to think if they had, if they save $1 million their whole life, they were going to be able to live on $80,000 a year. Now they got to live on $15,000 or $20,000. So there's always some reason why there's no free lunches, it seems like.
I also think, Joe, if I could just add to that list real quickly, the idea of having something left over to do in case we get into a real problem here.
Right, dry powder.
I think Powell would not hesitate to act if you started having a serious drift up in the unemployment rate, if you started printing GDP prints, below 1%. I think he would act and act forcefully, but he wants something in the tank, Joe, I think, to move ahead. And he's given what he thinks is a good amount of stimulus that has several months to play out through the economy.
And, Steve, I would say that notion of preserving ammunition has sort of come back into the consciousness of a lot of people. I've noticed it just in the last few weeks. Several months ago on this show, in a conversation with you, Steve, I said that I felt that was in the back of the mind of some policymakers, that they don't want to use your ammunition when you may need it in a much more severe set of circumstances. And that idea now, I think, is back in play.
Great. All right. Dennis Lockhart, thank you.